I'm expecting that the surge that we saw in breadth is going to turn out to be just a bear market rally, irrespective of the positive signal from the Zweig breadth thrust signal. And we're going to have some more pain this year.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When markets are as volatile and the macro outlook as uncertain as we've seen in the past few months, turning to the data and navigating by what it's telling us is often highly useful, which is why we're fortunate to have one of the best technical analysts in the industry, Tom McClellan, joining us today to share his latest interpretation of the current market action. Tom, thanks so much for joining us.
Adam, good to see you.
Good to see you too. It's been a while. I'm so glad that we have you back on the channel. And Tom, as I said right there in the intro, it's been a kind of a chaotic couple of months for investors. And so the analogy I like to use is it's sort of like flying a plane, right? The pilot looks both outside the window, but also at their instrumentation and, takes both into account. But when things are kind of murky outside that windshield, you have to rely on your instruments a lot more, and it feels like we're at one of those times in the market right now. So very happy to get a chance to peek at all your instrumentation. I know you've prepared some slides for us. Real quick before we get into it, two questions for you. First off, just in general, how would you, having looked at markets for your very long and successful career, how would you characterize today's markets?
Well, first, I like your analogy about being a pilot and having a plan and having instruments, because I flew helicopters in the Army for 11 years. And so I really like it having a flight plan. And then I also like to make sure that, yes, I am where I'm supposed to be. I am at the right place on the map, and the instruments are confirming that everything is happening. And if it's not, then I got to circle back or pull up a different navigator or something like that to find out where I am and get myself back on track. And that's the way I approach the markets. I like to have a plan, and I like to know what's supposed to happen. And then I like to have confirming indicators that tell me, yes, indeed, things are happening as they're supposed to, or no, hold on, whoa, something's different now. Mm-hmm. And when everything's happening like it's supposed to, I can trade with more confidence, trade more aggressively, trade, more heavier positions when things are not going as well. Maybe it's time to lighten up or step aside until the market starts making sense again. And so
it's great doing
a bit of that this year. Some of what's happening this year is what's supposed to be happening. Other things that are happening this year are a little bit unexpected and uncommanded, but and I brought some charts to talk about all that if you want to get into those.
Okay, yeah, we'll get in just a second, but I'm just curious. So when you say some things are going as planned, some things are surprises, is that sort of standard in any given year, or is this year more extreme one way or the other?
Well, that's a good question. I would say that this is a more chaotic year than average. Not surprisingly, because we have a slightly more chaotic president in office that nobody knows how to understand. And so that affects people's emotions, and people's emotions affect their decision making, which affects how prices move. And so you get a lot more what I call sloshing of the bathtub. The same amount of water's in there, but it's sloshing back and forth even more because you got a bigger 800-pound gorilla taking a bath and making waves.
All right. Well, regular viewers of this channel know that I loves me a good analogy, and that sloshing of the bathtub I think is a great analogy. So this goes to my next question, which is, you're a technical analyst. I've actually interviewed several over the past week, saving the best for last, of course, you, Tom. And the last one I just talked to said, hey, look, I try not to look at what's going on in the world. I try not to read headlines. I just look at price action. So I'm just trying to trade the market I have as it's telling me it wants to be by price action. So he doesn't take any macro into account. Do you take macro into account at all in your practice, or is it, again, like this previous fellow, just the data, and that fellow is just FYI, it's Mark Newton from FunStrat. And whether you do or whether you don't, we are in a world right now, as you said, chaotic, because we have this sloshing of the bathtub with the 800-pound gorilla, being the new president. It's one of these environments where, I don't know, by the time we're talking, Tom, it wouldn't surprise either one of us if there was some big pronouncement made by the administration that the market reacts to. So, can you fly by your technical analysis instruments as confidently in an environment like this? Or is it hard because, yeah, okay, right now they're telling me the direction's this way, but a crazy headline could happen in an hour that sends the direction somewhere totally different.
Oh, and that's exactly right. And I'm sympathetic to the idea that you just watch the charts and you turn off the financial news and don't watch TV. But that works until somebody flies a plane into a building.
Oh, exactly. That's sort of what I'm curious with this question.
And,
Yeah.
and I keep the financial news on all day long, mostly just so I know that nobody has flown a plane into a building today and that there's nothing irregular happening. Sometimes you and I are both from California. I grew up in LA. You're in Northern California. You have a surf forecast, and they even talk about it on the radio, and they tell you what the swells are going to be at this beach and where it's going to be. And so every day the surf forecast is actually pretty good because we've figured out meteorology and we've figured out how the waves work. And the surf forecast worked great most of the time until the day the asteroid falls in the ocean. And then, it's not that the surf forecast was bad. It's just the surf forecaster didn't know about the asteroid. And so there are asteroids that fall into the news, and those things do happen. And so you do have to acknowledge those and see if those represent opportunities to step aside or take advantage of it. You can't be totally ignoring of all the news, but and being able to put the news into context helps oh, okay, something's due to happen. I don't know what's going to spark it, but okay, there it is. That was the spark that we were missing, and it's coming along just the right time to make the price event happen that I was expecting to happen. So yeah, I do kind of pay attention to that. I don't give it a lot of credence. I don't do my planning based on what I see in the news agencies reporting to me because first of all, I don't trust them to give me all the right news perfectly accurately, but I want to know what's happening in the world because that can come along and send a rumble through the liquidity stream.
Okay, so it's not a driving input to your methodology, but it's one that your methodology has the flexibility to react to if you deem the asteroid as big enough.
That's a good way to say it. Yeah.
Okay, great. Well, look, I'm sure I'm going to ask you some questions about a couple of asteroids along the way here, but why don't I let you get started on your slides, and you can tell us sort of what your models are telling you about current market action, where do you think it's going, and then, like I said, maybe I'll say, okay, what if asteroid X occurs? What will that do?
Sweet. Well, the first point to know is that this is supposed to be a bear market year this year. And I say that based on a long-term leading indication that I get from crude oil. This has crude oil prices all the way back to 1890. When
I remember this chart. Okay. Yeah.
I've done this chart before.
This is the spooky one. Yeah, the correlation's ridiculous. Yeah.
Crude oil prices started dropping big time in 2014. And so with the 10-year offset, that should have meant that stock prices should have started falling dramatically in 2024. We're a little bit late making that turn. And if I zoom in on the relationship a little closer, we can see that a little bit better. This is the same idea. Crude oil prices are shifted forward 10 years to give a leading indication. And they tell us what stock prices are supposed to do about 10 years later. Now, it doesn't always work out perfectly to 10.0 years. So, for example, we had a great bottom in crude oil prices in November of 1998. That should have meant November of 2008 would have been the bottom. It was in March 2009. Still was the right bottom. It was just not exactly 10 years later. So when I say 10 years, don't get out your calculator and calculate exactly what it's supposed to be. It's a roadmap. It's a flight plan, and the stock market's going to look approximately like this, but not exactly like this. So here we are, we're in 2025. We're supposed to be in a bear market lasting all the way till the 10-year echo of oil's prices bottom in January of 2016. So ideally, that would mean a bottom in January 2026, plus or minus. We have started downward a little bit late because I think that a lot of the late rally in 2024 was people anticipating a Trump victory, and he's going to solve all our problems and everything's going to be great. And the trees are going to grow to the sky and we won't ever have any troubles anymore. And it'll all be fine. And that was all fine until he actually got inaugurated and reality set in and people realized, oh, wow, he's creating a little bit of a turmoil. And so we're finally getting onto the agenda that we were supposed to be on already. So that's the environment that we're in, and we're not due to be out of this environment all the rest of this year, but prices don't ever move in a completely straight line. There's going to be volatility along the way. One of the things that has happened that's interesting this year is that we had an advanced decline line divergence. Now, this is a historical chart. This is comparing the Dow Industrials on top to the daily advanced decline line for the NYSE. And this is just to show you why I pay so much attention to this, is it sometimes gives you these really great important indications. If you get a higher price high and a lower high in the advanced decline line, we call that a bearish divergence. And that's a big deal. That matters because we had one of those at the end of 2024 and early 2025. We had the S&P 500 making a higher high and a lower high in the advanced decline line. Big bearish signal, or not a signal, big bearish indication. It's a bearish condition, and it led to the liquidity problems that we experienced earlier this year. We had another one of those back in 2021, leading to the bear market of 2022. We've also had little divergences along the way, like in summer of 2024, but it did, in that instance, it did what sometimes can happen, is that the divergence got rehabilitated. The advanced decline line started doing better. That's important to understand because now the advanced decline line has moved to a new all-time high, and it's done so ahead of prices. So that kind of negates the bearish message of the advanced decline divergence that we had earlier this year, but it's coming at a weird time because we're not supposed to be seeing this strength now, according to oil's leading indication and according to some other cycles. We're also not supposed to have this kind of strength in the first year of the presidential term when you have a new president in office. It's a different party than the last one, because when you get a new president from a different party, he usually starts trying to fix everything and gets everybody upset about that during the first 2 years. Then in the final 2 years of a presidential term, they declare victory for all the things that they fixed, and things start acting better. So that's why year 3 of a presidential term is always an up year. Year 1 is not so much always an up year. So this is kind of weird that we're seeing this advanced decline line strength now coming out of the April 8th bottom. We're seeing a lot of strong breadth, and that means strong liquidity. There's money available to come into the market. I don't know if it's money coming from Saudi Arabia or Korea or Taiwan or where the money is coming from. It doesn't matter where it's coming from. It's ending up in the market and it's lifting the majority of stocks. And that tends to be a sticky condition, but it's coming at the wrong time.
All right, fascinating. And so the question that all this raises then, which I'm guessing your future charts here will provide some increasing clarity on, but is what we're seeing right here at the right end of this chart. Is this, what was March and April just a correction in an otherwise bullish uptrend, or is what we're seeing over the past, this recovery we've seen over the past couple of weeks, is this a classic bear market rally, right? That gets everybody relieved and excited that, okay, the worst is behind us. Let's jump back into the market with both feet, and then the rug gets pulled.
You have stated the question exactly correctly. I congratulate you for that.
Well, thank you. Try to take good notes, my friend.
Well, and let's dig into this a little bit further and talk about what the breadth means. We've had a higher high in the New York Stock Exchange advanced decline line. We have not yet had a higher high in the corporate high yield bond advanced decline line. Now, this is some pretty obscure data. There's probably 3 or 4 people that ever look at this. I'm probably the leader of that group that got other people looking at it. Corporate high yield bonds, junk bonds, tend to trade a lot like stocks do. And they drink from the same liquidity pool that the stock market does. And so when they're doing well, that's a sign that there's lots of liquidity, because these are some really, really marginal investment vehicles. You wouldn't really want to put your grandmother's pension money in this kind of, because they're high risk, they're high yield, they might go broke. But so when they're doing well, it's a sign that there's lots of money. When they are diverging from stock prices, it says liquidity is getting tight and they're culling the weakest of the herd first. This advanced decline line has moved upward along with stocks, but it has not yet made a higher high. So it's in conflict with the New York Stock Exchange advanced decline line. This one can also go through what we call a rehabilitated divergence, where it was showing you a bearish divergence before, and then it starts moving better again and says, okay, never mind. Forget that warning when I was crying wolf earlier. So that may yet happen, but it hasn't happened so far. One of the things that has happened as a result of the strong breadth on the New York Stock Exchange is we got what's called a Zweig breadth thrust signal. Now, this was something created by the late Martin Zweig. He used to be a frequent guest on Louis Rukeyser's show, and he did a whole lot of innovative technical analysis research. He was the first one that came up with a put-call ratio back in the 1970s.
Wow.
He looked at instances when you have the breadth numbers going from really weak to really strong in a short amount of time. What does it mean? That was the question he was trying to answer. So he formulated some criteria and said that you have a 10-day exponential moving average of advances divided by advances plus declines. When that number of that 10-day EMA, when that goes from below 0.40 to above 0.615, that all has to happen within 10 trading days. If it happens in 11 trading days, you don't have a signal. It has to be within 10 trading days. In other words, you got to go from weak breadth to strong breadth in a short amount of time because there's a gush of money coming in. That's the criteria he established for the Zweig breadth thrust signals. We got one of these on the big rebound off of the April 8th low because we had really weak breadth going into that sell-off bottom. We had strong breadth coming out of that. So we got one of these signals. And since 1950, these signals have been pretty good. Before 1950, there were some real clunkers, but for some reason, since 1950, it's been good. However, they don't always work out right away. There's 3 instances out of the 9 that have happened in the last 30 years where you had a signal and then you went and made a lower low before you finally got the bullish message of it. That happened back in 2004. It happened coming out of the autumn of 2015 bottom. We got a lower low. It happened in 2022, early 2023, got a lower low after the initial surge. And so I think it's quite possible we're going to see another example of that this time, where eventually this is going to be a bullish message, or it could be a total clunker, but we could get a lower low first. And so that 2020, I want to talk about some of these exceptions, but I also want to talk about a different way of looking at strong breadth. This is something that Alan Newman of the Cross Currents newsletter likes to talk about. He likes to look at a 21-day sum of the daily advanced decline difference. So if you get a big positive number, that means there's gobs of strong breadth recently. And usually when you get a big strong number like that, it happens at the initiation of an uptrend, and it's a sign of a strong market. Usually you might get an overbought condition and need a correction, but usually it means that there's gobs of breadth. However, sometimes they can be exhaustive. They can be those big bear market rallies like we saw in 2022. This peaked in August of 2022, and then we went to a lower low in October of 2022. There's some other examples of exhaustive ones, but most of the time, it's a strong initiation signal. So which is it this time? And that's the critical question that's going to judge what happens next. I want to focus on this 2022 example because that was your basic bear market rally, like you were talking about, asking, is this one of those? And so I wanted to look closer at that. And so I put the two of them on a chart together, and here's what that chart pattern analog comparison looks like. And the darker line is the current period. This is current through Wednesday of this week, and it's compared to the stock price pattern of 2022. This is the August 22 peak. This is the October bottom that year, and so the pattern similarity says that so far we're playing out a very similar set of circumstances. 2022 was interesting. We didn't get a Zweig breadth thrust signal. in 2022. Although we did get very strong breath on this rally, it didn't get a signal because it didn't go from very weak to very strong all within 10 days. It did get to the very strong threshold. It just didn't trigger a Zweig breadth thrust reading then because it didn't meet the bottom criteria to the top criteria within the time period. But it was very strong, and we're seeing a very similar pattern now. It's not exactly the same, and there's a lot of other differences between 22 and now that one can point to. But I would say, well, if you're going to point to the differences between then and now, and you still notice that the pattern is the same, well, maybe those differences that you think matter, maybe those aren't the thing that really matters if that's not, if you're getting the same price action.
Right, right. Okay. Well, so it's super fascinating. So you've kind of given us some, from interpreting this correctly, some data that on its surface level, is more likely to be bullish than not. The Zweig spikes and thrust spikes and stuff like that. But they can have exceptions, and this chart suggests that you can't discount that it might be an exception because the correlation here so far with 2022 looks pretty darn tight.
That's exactly correct. We have to be aware that this might be one of those exceptional periods. To get a Zweig breadth thrust signal is a big deal, and it says that there's strong breadth, but it's not a perfect indication. And speaking of exceptions, there was one other one. We did get a Zweig breadth thrust signal coming out of the 2015 bottom, and there was really strong breadth back then. This is another chart pattern analog, but then we got a lower price low in early 2016. We are showing an even stronger correlation to this prior pattern, which did have a Zweig breadth thrust signal, and it peaked out, and we had some choppiness, and then it went lower. So, and getting a decline into August and of this year, that would match the normal seasonal weakness that we see in July and August. So that's not a far-fetched idea. Eventually, after that, I think it was January of 2016 low, the stock market did end up going up much higher and had a great time. But we may not be through all the turmoil that the people in Washington, D.C. are going to cause for us, and the turmoil that was already programmed in 10 years ago based on what crude oil said was supposed to happen. So I would keep your seatbelt fastened and don't get up and wander around the plane just yet.
Okay. And let me ask you this too. How much credence do you put in the old market axiom, sell in May and go away? Is there a lot of evidence on that? Or is it just kind of a vestigial, saying that doesn't apply as much anymore?
Well, it was the late Yale Hirsch who came up with that, of the Stock Traders Almanac. His son, Jeffrey Hirsch, is continuing his work. Jeff's a great friend of mine, does excellent work, amazing technical work, amazing seasonal work. The real seasonal peak is actually in July. There's an early peak in May, but nothing rhymes as well with sell in July. So if you say sell in May and go away, it's a much more attractive rhyming phrase, like if the glove don't fit, you must acquit. So that's why we're stuck with the May version of it. But yeah, it does matter, and part of that relates to why does seasonality work? It used to be thought that it had something to do with farming, and when you have farmers who are planting a crop, and they need money to harvest it, and then they sell the crop to the grain silo, and they get cash, and that creates a drain on the banking system, pay all the farmers the cash. Then that's what causes the fall weakness. That was the thought for a long time. Doesn't turn out to be all that true, and we still have this phenomenon going on, even though agriculture is no longer the huge economic engine that it once was. There's a better theory I heard from a Stanford professor at a class one time. He was talking about suicide rates in Nordic countries, when you're up very far north, and thus where the length of the day is much more dramatically variable than it is if you live closer to the equator. And there was a study done on this years ago, and they found out that there are two peaks in suicides in those countries where, the suicide is a really dramatic indicator of mood. If you're willing to commit suicide, and I don't recommend it, you're at a pretty low mood point. But the two peaks occurred in January, which kind of makes sense because it's really dark and Christmas is over and it's going to be dark for months more and it's cold and there's nothing to look forward to. So it's understandable that people would want to commit suicide then in January. But the other peak was in September. Now you think, why September? Well, in September, you're coming out of summer, there's still plenty of daylight, but the rate of change of daylight is at the greatest point in September. The day is shrinking at the fastest rate in September. And so your body notices that you're seeing the day getting shorter. It causes us emotionally to pull in, like, I better harvest my resources. I better put up canned food for the winter. I better pull everything in. And that makes you feel like I need to flee from the risk of the stock market. Whereas in the springtime, in March, daylight is getting longer. There's much more daylight. You feel bright, like I'm going to get out and do stuff, and it's much more optimistic. And so that is a much better explanation for the psychology of why seasonality occurs, is that we feel great when the daylight is increasing in the springtime. We feel bad when the daylight is shrinking in the autumn, and that's the better explanation for seasonality than anything else that I've ever heard anybody come up with.
That's so interesting. So, I cut my teeth early in my career on Wall Street, and they just used to say, well, that's because all the investors, especially in Europe, take the summer off, and that's why the markets just kind of lie fallow. So I had heard that was the reason for sell in May and go away. But both of those explanations you just mentioned are really compelling, and just on an evolutionary standpoint, right?
Yeah, and you think of, well, what about all the people in the southern hemisphere that works the opposite way? Well, the truth is more people live in the northern hemisphere than live in the southern hemisphere. And in fact, more capital is put to work by people who live in the northern hemisphere than by people who live in the southern hemisphere. Yes. And it doesn't matter what people think if you don't have the money to back it with your voting in the market. So it really matters what people in the northern hemisphere are experiencing.
Yeah, no, exactly. And what I like about your daylight explanation is I'm really fascinated by the field of behavioral economics, and it's about how, our evolutionary wiring results in all sorts of wacky decisions around money and whatnot. And, it makes sense. Like in the springtime, your body is reacting to the lengthening days by saying, oh, I'm going to be a little more risk seeking, right? I'm going to go out there. I'm going to go try to chase some game. There's a reason to get out of the cave, right?
I'm going to go plant some seeds.
Pardon? Yeah. But similarly, when the day starts shrinking, that's your body saying, all right, I got to start prioritizing risk. I got to start getting back in the cave. I got to start, worrying about not having enough food. So it's maybe just a human retrenchment of the psyche that causes this. Yeah.
It's a better explanation than anything else I've heard. I don't know how to prove it, but it's a reasonable hypothesis.
Okay, but back to my original question. So it sounds like you're saying it's almost less sell in May and go away, and more like after July, don't buy, right?
That's pretty good. I'll pass that one along to Jeff Hirsch, see if he wants to run with it.
Yeah, I'm not sure that one's got quite the zing to it, but timing wise, I guess you're saying it's a little more accurate. So it's between what, July and July and November 1st?
Yeah, well, and there's no good rhyming phrase for buy in October. You can't make a rhyme out of that.
Yeah, I'm not even going to try. All right, so what do we have next here? Well,
what I'm talking about is what makes the market move, and we're seeing similar physics involved in different periods. I like to say that the only two fundamentals that matter are, number one, how much money is there, and number two, how much does that money want to be invested? And so when we're talking about breadth numbers and liquidity, that's a function of the variation in how much money is there. But how much people change their mood about wanting to be invested matters a lot. We saw that when tariffs got announced, and people thought, I don't even know how to think about tariffs, sell everything. And now that the tariffs got postponed, then, okay, well, I can start thinking about earnings and the next quarterly conference and what the dividend yield is. And so they can get back to feeling like they can invest again. And so you get swings that happen in the money supply and the liquidity, and then you also get swings that happen in human emotions. And you have to kind of separate those two and think of which of those is operative. We've seen a swing happen in human emotion as evidenced by the behavior of the put-call ratio. This is CBOE data on all the options that they track. And every day, if you take the number of puts traded divided by the number of calls traded, that's the daily readings. It's very noisy. So I smooth that with a red line. That's a 5-day simple moving average. And the red line has gotten down to a very low level, equivalent to what we saw at the peak in January, equivalent to what we saw peaks right after the election when Trump's election was going to solve all the problems. And so when you have a very low reading like this, both in the daily tick marks and in the moving average, it's a sign of deeply entrenched confidence. People's emotions have swung over to the bullish side. They only want to trade calls. They don't care about buying many protection. And you know, it doesn't matter what the actual number is. The numerical value is not what matters. What matters is how it compares to relative to other values. These data tend to skew more, below 1.0. If exact number of puts and calls were equal all the time, you'd have a reading of 1. Well, it skews to the lower side just because people want to buy calls more often, because that's how we are. But when you get to an extreme like this, it says you have an emotional extreme. It says that people cannot get any more bullish than they are, which means that it's going to be tough for the uptrend to keep going. But they can get less bullish than they are, and we're starting to see that process unfold. And so this is factor number 2. This is how much does that money want to be invested? It won't tell you everything, because the how much money part matters also. How much money is also affected by what the Fed does. You may have heard that they are slowing their quantitative tightening, but the other thing that they're doing is they're still active in the reverse repurchase agreement market. We talked about this last time I was on with you. This is, if you read all of this, you're going to start falling asleep in my presentation. So just skim this a little bit to know what a reverse repo is and understand that they are important because they affect how banks have liquidity to make available to stock investors. That's the important thing about reverse repos. They affect the liquidity available. And this chart shows that. This blue line is an inverted plot of New York Fed data on reverse repos. I hope you're not falling asleep yet, because this is really wonky, boring economic stuff, but it really, really matters because of the sweet correlation that it shows to stock prices. I've inverted the data and I've shifted it forward by 5 trading days to show you how changes in reverse repos tend to show up a week later as changes in the stock market. And there's a very strong
sorry to interrupt, Tom, but let me make a quick analogy here just to help people who are falling asleep understand this, and you correct me if this is wrong. The way I think about the impact of reverse repos on the market from a liquidity standpoint is the reverse repo, think of it like a liquidity sponge. And as the reverse repo program gets filled, it is sucking liquidity from the system. And as the reverse repo program gets drained, it is sending all that moisture, all that liquidity back into the system. And that's what we've been seeing over the past, year and a half, 2 years, is that the reverse repo program has been getting drained. So you've been having all that water that was in the sponge go back out into the system. So that's what you're measuring.
I'm gonna have to steal that one. That's really good. But
Great.
so yeah, so the upward slope in this plot is actually a downward slope in reverse repos because I've inverted the scaling. And so that upward slope means money's coming out of lockup in the Fed and back in the hands of the banks to do things like lend out to people to lift stock prices with. But it matters even on a day-to-day scale, such that you can see the wiggles that show up in these reverse repos showing up again a week later in the stock market.
All right, fantastic. So obviously, the more liquidity that comes out of the reverse repo program, the more juice it's adding to financial assets. Yes.
Now, what's interesting just recently is we've had the initiation of this rally happen just as the reverse repo said, but then this plot peaked, meaning that reverse repos bottomed, and it's been moving in a way that says stock prices should go down, but stock prices continued going higher. And that was a function of just that emotion, not a liquidity. We had an overswing too far with emotion that brought us that very, very low put call ratio, but the money was being taken out of banks and being soaked up by the Fed again. And the market's realizing that and saying, oh, oops, I'm supposed to be over there. And it's going to have to work extra hard to catch up with where the reverse repo's saying liquidity is already gone.
Interesting. So, butcher another analogy here, but this is sort of like a rocket that went higher than the rocket fuel suggested it should. And so the danger here is that the rocket, you know, runs out of fuel and starts gravity starts taking over.
Yeah, or maybe just a car that went a little wide on a curve, and so the driver's got to oversteer to get back in his lane, and so the market's going to oversteer to get back on where this path says it should go. I wish this worked with a longer lead time than just 5 days. I wish this would tell me what the next 10 years are going to look like, but it only gives us a 5-day leading indication, but that's still better than nothing, and it's kind of fun to get the answers ahead of time, even if it's only a week ahead of time.
Okay. But even just with that short a time frame, it looks like the downturn in the markets here has just been only a couple of days so far. If I'm reading your chart correctly, we
And it was overdue.
all things being equal, yeah, overdue, but all things being equal, we should expect this downward momentum for a little while longer.
Yeah, subject to whatever the reverse repo data is that comes out today. Comes out usually about 3:30 Eastern time every day. You can access it from the St. Louis Fed's website. Here's if you look on this chart and write down this suffix to their website, that'll get you the data that you can use to plot this if you want to try this at home.
That's great. I really appreciate that you do that in your charts. It's a real service you do to viewers, Tom. Thanks.
Well, this is extremely obscure data. Who in their right mind would go looking at the St. Louis Fed website for data on reverse repos? Except that, if you look where nobody else is looking, sometimes you find a pearl.
Sometimes you do. And I will say, I think this channel will have a higher percentage of those types of people than your average YouTube channel.
I have no doubt. Moving on, I want to talk a little bit more about how money is supposed to matter. Reverse repos is one form of money. Most people think of money supply measures like M2 as being a big effect on the stock market, and for good reason. But it's a little bit complicated because what I'm showing here in the red plot is M2 normalized by dividing it by GDP. So when this plot is going up, that means that the Fed is creating a whole bunch more money faster than the expansion of the economy can absorb it. And when you see a big surge like this, you get a big price response about a year later. And a big surge back in 2008 and 9 brought a big surge in the stock market in 2009 and 10. We saw a big surge for COVID, and then we've seen the evaporation of that. What happens though when you start to take apart the money supply growth? There's a very much of a delayed response where you can see that there's a shrinking of this M2 to GDP ratio, but the stock market keeps on going higher. But eventually you get to a big payback moment. And usually that payback moment comes right when this curve is just starting to curve up again, actually a year later. And so here's another example from 2011. You get the big payback right at the inflection point a year later. Here's 2015. There's a little inflection point. You get the big payback. 2020, the COVID crash happened right at the right time to mark the inflection point. We get the payback. So we have the payback this time is ideally due to occur a year after the July to October bottom of the M2 to GDP ratio. It's a really messy bottom. It's not a spike bottom. So pointing out when the exact bottom is supposed to occur is going to be kind of rough. But we're supposed to be getting this inflection, this payback moment later this year. And so, and that's payback for having the money supply drop so dramatically. When there's more money, you can bid up stock prices with it. When there's less money, you have to take the money that you have and do fewer things with it. That's what a shrinking M2 to GDP ratio is all about, but it works with about a 1-year lag, which is very mysterious and hard for people to understand that it would work with that long of a lag. Only when you put them together on a chart can you unlock the relationship and see how the key of it works.
Interesting. So, okay, so this chart says, coming up in about 4 months, we would expect to see the payback manifest. Let me ask you this, Tom. Is there any correlation between the size of the surge and the size of the payback drop?
Well, the first thing to know is that this 1-year lag relationship has only been working for about the last 30 years. If we go back in this relationship to the 1960s, it worked on a coincident basis, which is interesting. In fact, people used to gather around their quotrons for the weekly M1 and M2 release to find out what they were doing because it worked so well, so perfectly correlated on a coincident basis. In the
Meaning you didn't have
80s,
to shift it forward?
it didn't have it shifted forward. It worked
Okay.
coincident. In the 80s and 90s, it switched to about a 6-month lag. And then for the last 30 years or so, it works with this 1 year lag that we're showing. And so we only got these 4 or 5 instances prior to judge by. The COVID response occurred at the right time, the right payback moment where you had the inflection. But it was a much bigger response because of everybody panicking about COVID. And so if you're asking about the magnitude, I'm not sure you can really make good correlation of magnitude to this. I mean, because this was a big magnitude drop in M2. Does that mean that we get the same magnitude drop in the stock market? I wish I had the data to answer that. This is going to tell you more about the when than the how much. But if you get the when right, then the how much will take care of itself.
Yeah, I just wanted, if somebody was saying, oh gosh, well then Tom's saying we're going to have a massive drop in the market, come around October because of this massive drop in M2. I just wanted you to clarify that. You would say, slow your roll. We don't really know. We've got more confidence in the timing of some drop, but we don't have as much confidence in the magnitude of the drop.
Yeah, and I would say that the drop doesn't come in July to October. The drop ends on this time frame, approximately.
Oh, okay. So it
don't
should
set
be.
your watch to this. It's approximately, and it can be a little bit late. I mean, the March 2009 bottom was a little bit late, but the financial crash of Lehman Brothers occurred right at the inflection point, right when it was supposed to. So you cannot set your watch for when to buy stocks based on this. This is giving you an approximate roadmap. If you want to know when the next surge is coming, watch M2 to GDP and see if you see another big surge like this, and then count your watch a year later, because about a year later, you get the big surge in stock prices. So far, M2 is starting to rise. We're not seeing a big surge yet.
Okay, sorry. So now 2 more questions. I maybe didn't hear correctly. So what does this chart suggest about the timing of the start of the payback period? Now?
Well, I think that we're in it. The stock market tends to go against that message for a long time and keep going higher, even though this ratio said it was going down. We saw that in 2019. We saw that back in 2010. That was going against that message. But eventually, there's that moment of payback. So we're finally reaching where we have that moment of payback. I think we have started that process. It's due to conclude ideally a year after the July to October 2024 bottom of this ratio, but that's very, very approximate.
Okay, so sorry. So this chart then suggests we've started the payback period and to expect the next couple of months to be, rocky to the downside.
Yeah, this is supposed to be a bear market year.
Right. Okay. So the surges that we see on this chart, and again, this only goes back the past 25 years, but those surges seem to be correlated with, central planner rescue efforts.
Yeah.
Right. Dot-com bust, great financial crisis, COVID. So is sort of the thinking that, okay, things will get rocky from here through July, October, and then we're going to see some central planner response to come in and help rescue things.
That's a pretty good hypothesis. The Fed has one playbook that they keep repeating over and over, and to expect them to work differently, especially when they are a committee of people and not one person who can learn from history, to expect that to be different this time would be kind of pushing against how the historical norms work. They usually act too late and then they overact, and so yes, you can expect that cycle to repeat.
Okay. And what's fascinating is, I know you didn't have a chance to see the video with Mark Newton. He's got pretty much the inverse forecast that you have right now, which is that things are going to strengthen until the fall, and then he's like, he said, I'd like to come back and call an audible then, but right now his model suggests that things will get rockier starting in the fall. Now, in Mark's defense, he did not have a chance to share his screen or go through any of his charts, so he didn't. We don't have the same visuals of his to compare with yours, but I find it interesting how, just like on the macro side, you can have smart people look at the same events and come to different conclusions. you guys are looking at probably different data sets for the most part, but obviously same market data overall, and coming up with different market views. So it'll be very interesting to see what happens here as this story unfolds.
Mark Newton's a very sharp guy. I I don't discount at all his ability to look at things and draw great conclusions. I'm making a leap right here and talking about the July to October 2024 bottom in this. I'm making a leap to say that this was the important bottom. That's facts not in evidence yet, because we're still drawing this line every month when we get more data, and it could do something weird. This could be just a temporary pause and not the real inflection point. So that is a very much of a possibility.
Got it. So if that rolled over, which would mean that the ratio was weakening, it wouldn't necessarily mean bad things for the markets, because it would not be it would be pushing out the inflection point.
And rolling it over arguably wouldn't be a bad thing, because if you start constraining the money supply, then you do helpful things to inflation. But doing helpful things to inflation can sometimes be a painful process.
Yeah. Okay. By the way, I don't want to interrupt your momentum here, so we'll let you get to the next chart. But I just want to help me remember to ask you at some point about the impact of rising bond yields to all this. In other words, that is an asteroid that could come in and slosh this bathtub around.
It very much is, and I didn't share my slide deck with you, but you're doing a good job of foreshadowing, because that was my next slide, and we are expecting to see a big rise in long-term bond yields. And the reason for that expectation is the message from gold prices, which you may have noticed zoomed up above $3,000 an ounce. This is a chart which shows the price of gold on top shifted forward by 20 and a half months to reveal how the long-term bond yields, this is the Treasury Yield Index, tends to echo those movements about 20 and a half months later. Not perfectly, and it goes through some wild periods where it gets off track, and the magnitudes get weird sometimes. And the COVID crash really spiked yields down, but it did it right at the right time. So don't use this to judge what the magnitude for yield is going to be, but it's a pretty good indicator of the direction. And it got really weird at the end of QE2 back in 2011, really just way off. So put your thumb over that part of the chart and look at the pretty correlation in the rest of it. You can even zoom in on this relationship very close to look at day-to-day moves, understanding that sometimes it'll get off track when the Bank of Japan has a surprise rate action, but then it gets back on track again. And you can count the moves in gold and see the same moves showing up about 20 and a half months later. This rise that we've had the last 2 weeks, 3 weeks really, in bond yields has come right on schedule with a small rise that gold talked about. It says now we should see some chopping sideways for yields, and then June into June should be a drop in bond yields to match the drop in gold, and that should be a really fun time to be a bond trader during the month of June. But that's going to be the low for yields at the end of June, and then gold says yields should start rising. Now, how far and how long? Well, here's that first chart again. All of this upward movement in gold has not yet even come around on the clock yet for yields to start echoing. We're still in the echoing of this years-long sideways period, and we have yet to have the echo of gold rising up to above 3,000 starting for yields. That doesn't mean that yields have to get to any particular number, but the next 20 and a half months for bond yields are going to be a rising period. And yes, that's going to start attracting money away from the stock market and going to create problems for anybody wanting to borrow money, get a house, and build a factory, and lots of other things.
Yeah. So, okay. So again, sort of like the previous charts, it suggests the trajectory, but not the magnitude, right? So you don't know what bond yields are going to rise to. You just know it's going to be higher than what they are right now. I do want to note too, the data set you have here for gold looks like it gets up to about 2,700, and the day we're talking, gold's over 3,300. So there's still even more to this story than's reflected on this chart, right?
That's true. I chopped off the last part for gold just so we could see the wiggles at these lower levels. gold is up here somewhere. So yes,
Okay.
the message continues for at least the next 20.5 months. At some point, if gold starts falling back down again, then you can start your watch and count 20.5 months to look for a drop in long-term bond
In
yields.
long-term bonds, yeah. Okay, but basically the direction of bonds is higher and then higher still because we know that gold is even higher than this chart reflects. And then after that, obviously it's TBD based on whatever gold does.
Yeah. And so the importance of that for policy is that the Fed might have their intentions of what's supposed to happen. Congress might have its ideas of what they think when they want to get done. The White House might have their own ideas, but they're going to get a dose of James Carville's admonition about wanting to come back in the next life as the bond market because of how powerful it is. And their plans are going to get, their flight plan is going to get disrupted a little bit by the weather.
Yeah. Okay. And I guess back to my earlier question about uh, the spikes in M2, being a result of central planner intervention. I'm looking at the COVID crash divergence here, which had a lot of central planner intervention on it. So, I mean, the central planners can act in a coordinated way to bring yields down, right? Like in other words, they could do QE again, right?
Well, but QE didn't really help the long end. QE and zeroed interest rates work on the short end, but during periods of QE back in 2010, 11, back in it did the opposite effect on long term. You'd think that if the Fed was becoming a huge buyer of long term treasuries, you would think that that would push yields down. It didn't work out that way. It did the opposite.
Okay.
So if the Fed does QE because of huge economic problems, that would actually fuel long-term yields going up based
Sure.
on how QE has worked the last 4 times that we've done it.
Okay. Well, and that's something that Bill Fleckenstein has been predicting for a long time, that eventually the bond market is going to take the printing press away from the Fed. And that would be an example of that. If the Fed started doing QE and the bond market said, well, this just makes us even more nervous, pay us even more for these longer term bonds. This is kind of what you're saying.
Yeah, and we've seen a little bit foreshadowing of that as the bond market has been worrying about the big, beautiful bill before Congress and whether they're going to get the spending cuts that everybody wants or that some people want. And there's a little bit of bond market nervousness about additional supply of treasuries coming because of that lack of austerity.
Yeah. Okay. And I don't want to get too much off on the macro side, but we do have a lot of bonds this year and next that need to be refinanced, and the administration has a big incentive to refinance them at lower yields than we have right now. From your correlations, it sounds like you would say, get used to disappointment, folks.
Well, get your refinancing done in June because it may not be at the rate you want, but it's going to be the best rate you're going to find.
All right. All right. Oh, fascinating. Okay. All right. Well, let's see what else we got.
Well, just bottom line, the gobs of breath that we have seen, it is a bullish message. It means that there's been a lot of liquidity surging into the market. From what source, it doesn't tell us, but gobs of breath is usually bullish, but it's showing up at the wrong time. And that creates a big interpretational conflict for me and others. Since we're supposed to be in a bear market year, I'm expecting that the surge that we saw in breadth is going to turn out to be just a bear market rally, irrespective of the positive signal from the Zweig breadth thrust signal. And we're going to have some more pain this year because we're supposed to be. Next year's looking much better. So if you want to be a buy and hold investor, sit on your hands for the next 9 months, and next year should be a great time. But you got to wait through winter before you can start planting again.
All right, another great analogy. Okay, so in terms of where we are in this crazy year, this chaotic year, as you said earlier, there, we'll say cross currents, but you're, as best you can tell right now, you're putting your money on this will prove to be the bearish year you thought it was at the start, and that what we're seeing right now is more likely to be a bear market rally than a return to, the previous bull market uptrend.
That's my answer today, subject to change, but that's what I'm seeing. It is impressive that we've seen the advanced decline line move to a higher high. That's a really tough thing to get done absent a lot of liquidity, and liquidity tends to be a sticky feature. But there are enough exceptions in history to allow for that to be the case this time. We're supposed to be in a bear market year. I think that history is going to get back on it on the right side of things. And once we get settled down about how tariffs are going to affect our lives, we're going to get back to focusing on other things. And the long-term liquidity flows really do matter.
Okay. All right, Tom. Well, look, so let's assume that the markets play out that way. They play out based on your base case. Do you have any recommendations on how, investors should think about playing that? Is it just gird yourself, build up dry powder, wait it out, then deploy? Are there certain industries or sectors or asset classes you think are, wise to consider to hold here? Obviously, long-term bonds you're probably not super excited about, given that you expect yields to go higher, but maybe you're bullish on gold because gold's going up and you expect that momentum to continue. Don't let me put words in your mouth, but at the end of the day, what's the so what of all this for investors?
Well, for active investors, this is a really hard thing to get your mind around, but sometimes T-bill and chill is the right way to go.
Okay.
If you really want to play, though, grains should be a strong area. This same idea that gold acts as a leading indicator for yields, gold acts as a leading indicator for grain prices with about a 12-month lag. For corn, wheat, rapeseed, corn is not acting as well as other grains are right now, but generally speaking, the big move that we saw from 2000 to 3000 in gold, that should get reflected in grain prices. And so some people may want to trade grains directly. Some may want to trade things that are related to grain prices, like fertilizer stocks or John Deere, or when a farmer is suddenly making way more money on his crop, then he can afford to buy a new harvester next year, and so that affects tractor prices and those kinds of stocks. So I think that's going to be a favorable area for the next probably 10 months till we get to the echo of gold's all-time high. If you really have to play that. Full disclosure, I'm long one fertilizer stock called Nutrien. It was formed as a merger of potash and one other company. It's a Canadian company. And generally speaking, when when grain prices go up, farmers tend to buy more fertilizer because it becomes incrementally more profitable to fertilize more and get and boost their yields to get into that higher prices than it is when grain prices are lower and they're trying to squeak by. And so that's why fertilizer company stocks tend to correlate really well with corn and wheat prices. And I'm expecting that the next few months that fertilizer stocks, which is really boring. I mean, that's not like microchips and data centers. That's fertilizer. Who cares about fertilizer? But that's what looks good right now. I'm not excited about gold today. It is in the midpoint of its 13.5-month cycle. I didn't bring a chart for that. There's usually a midpoint low somewhere around here. It has more correcting to do based on the commitment of traders data, which has shown that the big commercial traders were really, really short a lot. And when they get down to a low net short position, then I'd be much more interested in being a buyer of gold or silver than I am right now. I think that has more correcting to do.
Okay, and just on that, because you mentioned gold, and we talk about it a lot in this program. So short term, it has more correcting to do. In terms of its mid to longer term price channels based upon all the correlations you look at, do you have an opinion after the correction where you think it's going to head?
It should swoop up again for the latter part of the cycle, due to bottom about 6 months from now in a more important way. Again, the cycle length for gold is 13.5 months. If gold can make a higher high on the second part of this cycle, then that's really bullish for next year. But it doesn't excuse the need to have a bottom about 6 months from now for gold. This is not going to be a great time for gold, but it's not going to be a bad time. And the big unknown macro effect on that is what's China going to do, and what's Pakistan going to do in India? Where are their central banks going to keep buying gold? That's the big elephant in the room. I I traded through 1999 through 2001 when the Bank of England thought it was pointless to hold gold anymore. And so they were selling off their reserves 25 tons a month. And that really pushed gold prices down. Now we have central banks thinking that gold is the hot thing to own, and they really can move the markets. And that's a big part of the magnitude of what we have seen. My worry as an analyst who uses gold price plots to tell me what other things are going to do is, what if you have central banks being the big buyer, are they skewing the message, the
Right.
economic message, and it's not going to flow through to things like grain prices as much? That's my big worry, and I don't know how to resolve that.
All right. And I'm curious because, I mean, yeah, the central banks are the dominant buyers right now, and at least in the gold market. Um, are you seeing any signs that the signal is not proving to be as true as it once was, or is it still working?
It's an unknown question because we haven't got to the fat part of the uptrend in gold in terms of the lag effect on interest rates and grains yet. We have seen some disruption of other indicators. So, for example, I like to look at the assets in GLD and IAU, which were the two big gold bullion ETFs. And
Mhm.
usually when you look at those assets, you knew what the public was doing. If the public was getting overly excited about gold or under excited about gold, if everybody was selling out of GLD or IAU, then that was a bottom. If everybody was jumping into those, it was a top. That has been disrupted because the public has not been the incremental buyer, it's been the central banks. And that really irritates me when I have a great indicator that gets
Yeah.
disrupted by somebody.
Yeah. Back to Stockman's term, the great deformation, right? Once the central planners get involved, price signals get deformed, and it's frustrating when you have something that's pure and working, and then all of a sudden it's all adulterated. All right, so just last question here on assets. I mentioned this earlier, but I just want to get your confirmation. You are probably would say avoid long duration bonds in this market, right?
After the end of June, for sure. You got a great trading opportunity for a rally in June. So if you're a T-bond trader or you like TLT for a 1 month trade, this is looking like a pretty good time to start scaling in for a trade, not for an investment.
Okay, so
June is a good time to lock in your refinance on your mortgage.
okay, that's an even more practical way. Okay, so if you're kind of a speculative active trader, you could get in a bounce here in June. Or if you're just a regular person and you're looking to lock in some consumer debt, probably not a bad time in June as well because you expect yields to go higher as we get beyond June.
Very well said. Yes.
Okay. All right. Well, Tom, always super fascinating. Most important question of the interview. Where can folks go to follow you in your work in between now and the next time you come back on this channel?
Well, go to our website, mcoscillator.com. That's a contraction of McClellan oscillator, the indicator that my parents created back in 1969. My dad's 90, going to turn 91 this year, still active, still driving, still
That's
working with
amazing.
me every day. He's going to be a featured speaker at a Foundation for the Study of Cycles conference in New York next month, talking about how breadth and cycles work together. And so go learn about the indicators that we use and develop at our website. We have a big free Learning Center section there. You can read lots of past articles. If you want the good stuff, we have a twice monthly newsletter and a daily edition that comes out every day the market trades.
All right. And as a subscriber to that, folks, it is every bit as good as you would think it was having watched this video here. Tom, thanks so much. And look, please give a big hello and just a bunch of gratitude and goodwill from the Thoughtful Money community to your dad for everything that he started. You have taken over the torch very well from him, admirably. But please, give the original pioneer our strong gratitude.
Yeah, well, and a little story about that. My parents did it together. My mom passed away in 2003,
Hmm.
but my father went to Claremont Men's College and studied finance and economics, and it was always interested in markets. He met my mother there. She went to Pomona College, was a math major back in the 50s when it was not very fashionable for young ladies to do that, but she was wicked smart in math. And it really, in 1969, there were no personal computers. So it really took the talents of both of them to be able to compile the data, to calculate exponential moving averages on paper and to plot them on graph paper, and then to figure out what it meant. Neither of them alone could have done it. And it took them both together. The key insight that became the McClellan oscillator was that they were looking at exponential moving averages on their own, and they were tabulating it in a ledger, and they wondered, well, what happens if you take the difference between one moving average and another moving average? And Gerald Appel in the 1980s took that and created what became known as MACD, but it was really the insight of Sherman and Marion McClellan in 1969 to find the difference between two moving averages that was the pioneering work, and people still use it with good effect today.
That is amazing. And yeah, I mean, millions use it daily. I mean, the MACD or just the McClellan oscillator itself, they really changed the game out there. And the fact that they were not only, calculating it all by hand or with, early calculators, but the fact that they were then charting it all on actual graph paper.
Well, I remember when my dad bought a calculator, an electronic calculator with an LED screen, and it ran on 4 C-cell batteries, and it cost him $110 in the 1970s, which was a huge amount of money. But he was ecstatic to have this device that could do the calculations instead of having to jot it down on scratch paper, and it was amazing. And he eventually went on to much better devices and calculators. But it was, people don't understand what it took to do analysis back then, and you get. I started doing charting back then, and that's why I am biased. You see in all these charts that I have a white background and a black plot, because you're supposed to do it with a pencil on white graph paper as God intended. And these people who have a black background and dark lines, I can't understand why they make charts that way.
Well, it's funny, and I'm just curious if you have a sense of how your father feels about it. I as I mentioned, I started my career on Wall Street, and really kind of at the exact wrong time, which is where they could see the potential for where the technology was headed, but the technology wasn't there today. So they were basically making tomorrow's demands on you with limited today's technology. And that went from everything from spreadsheets to graphing programs like PowerPoint and stuff like that. But just even if you wanted to understand a company's like if you want to understand a company's PE and other ratios relative to its peer sets, well, you had to first figure out who all the peers were, and then you had to go call the Edgar archives and request all the 10Ks and 10Qs of these companies, and they would get couriered over to you, and you'd get just stacks of paper like that high.
Unless you could get them faxed to you.
Oh, that would have been wonderful. But no, we had to wait for the courier, and then we had to go through page by page, right? And individually enter them all into spreadsheets and then correlate everything, right? I mean, it would take you weeks. I mean, to really, if you big enough competition set. And now I can just go to Yahoo Finance and just request it, and I instantaneously get it, right? And part of me says, this is amazing. I'm thank goodness for technology. But there's part of me that's so bitter of all the months I wasted doing it the old way. So I'm curious.
Back in my day, well, kids, listen,
Yeah. So is your dad happy he doesn't have to do that anymore? Or does he look back and think, oh my God, I could have saved years of my life if I had this technology back then?
Well, he entered the workforce coming out of college at a bad time, like you just mentioned. He graduated from Claremont Men's College in 1958, right into a huge recession and bear market from 1957, resulted in about a 25% layoff in the brokerage industry. It was a horrible time to come out of college looking for a job, and so he couldn't get a job in that industry. He had to go do other things. He and my mom ended up working in manufacturing and buying a plastic injection molding plant in Los Angeles, made parts for disk drives and aerospace and highly precision molded plastic parts. We're talking $7 or $8 per part for something that comes out of a mold because they were that precise. I worked there when I got out of the Army in 1993 before starting the newsletter, and he is glad now to finally, after all these years, to get to be doing what he wants to do and doing the analysis that he likes, and he loves working every day. So he's happy to have the tools that we have now.
Well, and I'm sure he loves working with his son too. So that's just wonderful. Tom, look, thank you. It's just been fantastic. And like I said, love to have you back on maybe in another quarter to kind of give us an update on where things are, unless an asteroid or other, affects your outlook. And if you want to, make an audible call in real time, you can come back on the channel anytime you like.
Sounds great.
All right. Well, look, thanks so much, folks. If you've enjoyed this discussion with Tom, please let him know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in figuring out how to navigate your financial portfolio through the road ahead, especially if it unfolds in the somewhat rocky way that Tom thinks it may from here, if you don't already have a good financial advisor to guide you. If you're a DIY person, then consider strongly subscribing to Tom's services there. But if you're not a big DIY person, or you'd like some professional help, and you don't already have a good advisor who's advising you, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorse. These are the firms you see with me on this channel week in and week out. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. You'll get bespoke, personalized advice to your unique situation there, and there's no commitment to work with these firms. It's just a service they offer. All right, Tom. Well, look, I'll let you have the last word here. The vast majority of today's viewers here of these videos, even though we do have a number of professional investors who watch, they're just regular people. They're just regular retail investors who are trying to build financial wealth for them and their families. And I would say, they'd like to do that prudently, continue building it from here, but more importantly, they don't want to get washed out or be collateral damage to some of these downdrafts that you might expect in a bearish year. So, any parting bits of counsel for that segment of viewers?
There is a place for buy and hold investing. 2025 is not that place. There will be a great opportunity to ride a great uptrend from 2026 to 2028, but we have some storminess to get through first this year.
All right. Very well said. All right, Tom, can't thank you enough. Thanks so much for coming on again. And everybody else, thanks so much for watching.